Hey, my name is James Baker, and thanks for being here. This question comes from our Ask Me Anything. We have a private, well, it's a public Discord server where every week, once a week, I answer all the questions that you guys have. So if you have questions about international taxes, investments, business, marketing, sales, all that fun stuff, mostly, specifically U.S. income taxes and sales taxes. I encourage you to click the description below, join the Discord, join the Telegram, and come to our next call. If you just want to see the video and see the answer to this question, you have a great video coming. So just subscribe to this video and let's go straight to the question.
How does the IRS determine the value of a condominium apartment since the depreciation is only on the building and the furnishings, not the land? So how to determine depreciable value of a property? That's the question. And it's based on the fair market. Well, it's based on your cost basis. So it depends how much you paid for the property. That's how you depreciate it. So if you bought a house, then that's whatever you paid for it, including all fees, all the stuff you paid, you capitalize it into the value of the house. You bought a house for $1 million. It's $1 million house. That's amazing. It doesn't matter if you have a loan. It doesn't matter anything. It matters the cost paid. If you have a loan, that's fine, but it still doesn't change the cost basis. Whatever you paid, you paid. Whether you paid $1 million cash or you got a loan for $1 million, it's the same cost basis. So how do you determine the separation between the furnishings and the land and the building? Well, the first step would be check the contract that you have. If that's specifically stated somewhere, that's great. Usually they have an estimated value of the furnishings. And if you can put it in the contract and you can attribute more to the furnishings based on your sales contract, that would be more helpful because furnishings are generally, you can claim bonus depreciation and expense them right away. So it's a bigger hit, more tax refund in the first year. And so first step would be checking the contract you have and how to determine the split between the land and the building. I mean, I have a story. It's fun because it's actually relating to my last question. This is one of the audits I was involved in. Generally, in my career, it's always been a 20% value of the property is for land. And that's generally what we've done. The IRS wants you to have just some kind of reasoning for how you did it. If you just say 10% or 20%, generally that's what most accountants will do because there's not always a good way to separate this. In this instance of my client who got audited, he had a condo on the Hudson River in New Jersey, across from Manhattan. It was a really nice condo. And based on I guess we could have pushed back, but based on the state website, it valued the land. So it was $1 million condo. They valued the land at like $520,000 on the state website, and it's pretty. It was a lot for me to. Usually for condos, I'm using 10% because the land is like there's only so much land and there's so many condos. But this agent made that change to it and reduced the depreciation greatly. So in my experience, the agents you could use a state property report, anything that kind of shows the value of the land. If you can see what an equivalent lot would be worth in the area, then you can use that if you want. But that's generally not going to benefit you. So most of my clients and my colleagues and everyone I work with, 20% value of the property is what they take for land. Again, depending. That's like what most people do. But I have an experience of an auditor changing that. And it didn't cause a huge issue, but it definitely increased the tax, right? So it's yeah, and if you have any kind of way you can do it and you can show it, the IRS will take that. But most people just taking 20%. But if you can look at land comps and document it and then assess it that way, generally the value of the land in the fair market is going to be higher. But when you have a house on it, it shifts. So you just need to have some kind of way to do it. And when you show the IRS, they'll either take it or they won't. So it's kind of a bad answer to a good question.
Hey there, I really hope you enjoyed the video. If you want more of this stuff, make sure you like and subscribe. And if you want to interact with me personally and join our weekly free calls that we have on the Ask Me Anything on Thursdays generally, click the description below. and join the Discord and join the Telegram. I look forward to interacting with you and helping you grow your business, be more successful, and make more money. Thanks for being here.